Hello, Gaurav. How are you?
Hi Bhaiya, I'm good. How are you?
Good, good, son. Good.
Yes, it's your birthday today, Bhaiya. Happy birthday.
Thank you so much, son. Thank you so much.
कि, कितने साल के हो गए भैया?
अरे ये सब बातें नहीं
पूछना
पूछा करते छो।
फिर भी भैया फॉर इंफॉर्मेशन हो.
I'll tell you later.
ओके भैया डन.
Okay. Last time we studied about investing and all, right? Although I'm going to teach you trading, but as such, trading and investing are integral part. I told you
ओके
that I am an trader, but I am also a passive investor. So you must have all the basic knowledge at least of all aspects. I told you about different ways of investing, active investing and passive investing. Active investor would study different kind of data flow and then make a decision for himself. Passive investor is somebody who would invest in different investment instruments like mutual funds, ETFs, and all various other instruments. So, but at least you should have basic knowledge. Even if you want to become a passive investor, even if you want to become a passive investor, you should have a good knowledge about it. In your management school, especially when you are doing MBA, then they do have these chapters on finance and all. But then again, they teach you on from academic perspective. They teach you from academic perspective, but here I am talking about the practical perspective. They teach you something like that is applicable for all world. But what is specific for India, what is how Indian markets are suitable for a particular product or not, all these things are not there in the academic books. So I'll give you my perspective as well as how things are there in the market, how I observe them. So there are various terms I have been using, mutual fund, ETFs and all. So I want you to go through them once again, even if you have been there in your PGDBM, then still we need to reread them. So I'll share some
ओके
screen
भैया.
and we'll discuss about mutual fund right now, right?
ओके.
Okay, Gaurav, just a change of mind.
हम्म.
What I'll do, before going to mutual funds, we can quickly discuss about money markets.
ओके.
We can quickly discuss about money markets, although this topic is neglected by most, but the understanding of it is always a good idea. So I'll explain a bit about money markets to you. Okay.
ओके.
So let me share the screen with you. Yeah, here it is. Can you see screen?
यस.
Do you see my
यस.
screen?
यस. या.
Okay, son. So see here we are talking about money market. I have taken it from Investopedia, so it's not my creation as such. So So see how they start. This I like this particular practical approach of writing. Whenever a bear market comes along, investor realize yet again that the stock market is a risky place for their savings. In fact, we tend to forget while enjoying the returns of the more market. Unfortunately, it is a part of the risk return trade-off. To get higher returns, you have to take on a higher level of risk. For many investors, a volatile market is too much to stomach. The money market offers an alternative to these high risk investments. The money market is better known as a place for large institutions and government to manage their short-term cash needs. However, individual investors have access to the market through a variety of different securities. In this tutorial, we will cover various types of money market securities and how they can work in your portfolio. ठीक है? So basically, money market. First of all, we need to understand what is money market. Money market is a subsection of fixed income market. Earlier, we understood fixed income market, fixed income,
नो.
the bonds and all.
यस.
No,
यस.
we
यस.
did
यस.
about
या.
bonds, fixed deposits, etc. The fixed income market that you invest, basically debt market.
ओके.
पैसा उधार पे देते हैं जहाँ पे where you are giving money
फॉर फिक्स्ड इंटरेस्ट.
for rent, ब्याज पे जहाँ पे पैसा दे रहे हैं. We generally think of the fixed term fixed deposit as being synonymous to bond. In reality, a bond is just one type of fixed income security. The difference between the money market and the bond market is that the money market specializes in a very short term debt security. Many money market instruments are also called cash investment because of their short maturity. So bonds etc. are for long term, right?
ओके.
Year, 2 year, 5 year, 10 years, 20 years, 30 years, 50 years, kind of 40 years. There are government of India bonds which are expiring in I think 2062.
ओके.
Yeah. So bond can be for such a long duration. Earlier I was holding bonds which had expiry of 20 years.
Okay.
my investment. So bonds can be, invested for a very long term for that secure long term fixed income. So they have their own advantage. Here we are talking about money market, which are very short term instrument. Money market instruments are accessible. IOUs issued by government, financial institution, large corporation. These instruments are very liquid and considered extraordinarily safe because they are extremely conservative. Money market instrument offer significantly lower return than most other securities. So they are liquid, they are very safe, and transaction cost related to them is very low. So when we compare low risk, high liquidity, and lower transaction cost, then what we get? Lower returns. Okay, so money market instruments are very low return paying. But what is the advantage? That you can park your spare funds into them. Let's say you are, for example, I give an example. Let's say you are looking to buy a house from 7 months from now. Now,
Okay.
what would you do for 7 months? You can either create a bank FD for this, or even if you are not sure that you might need this money in next 15 days or 6 months, so you cannot commit that money in a fixed deposit or something which has a long term commitment. So what you will do, you will invest them in money market, so that you can say, okay, at least I am getting something. You would say, at least
Okay.
I am getting something, if not much. So that's the idea. And if you are a financial institution, then money market is the money market is very important part for you, because you always have spare funds. Deposits are coming in, you have to collect money on behalf of others, and so on and so forth. So all those monies that are lying with you for not just short term, but for uh, what's the word, that kind of, you can say, undeclared kind of period, that you never know for how long you are holding this money. So where you will invest that money? You cannot invest
Hmm.
that money in long term bonds. You will have to invest that money in short term instrument to earn something out of that. So this is the money market. The easiest way for us to gain access to money market is the money market mutual fund, or sometimes through a money market bank. Okay, so I'll first tell you various instruments that are there. Treasury bills. Treasury bills are the most marketable money market securities. Their popularity is mainly due to their simplicity. So, for India, I am not too aware, but this guy Abid, who has worked in fixed income securities, he has great idea about T bills, Treasury bills. So basically, for India, these Treasury bills are issued by Reserve Bank of India on behalf of government. On behalf of government, Reserve Bank of India, which is our central bank, issues Treasury bills. Treasury bills are for short duration. I don't know for how long, maybe up to 60 days, if I recall correctly. Not too sure. You can check it for yourself. And now through various platforms, RBI auctions these treasury bills. RBI auctions these treasury bills, and now even retail participants can participate in those auctions. So earlier, all these facilities were not available 10, 20 years ago. I don't think there were such facilities available, but now we have this RBI auction accessible to all. So you can also participate in what you call these auctions of treasury bills, and directly buy it from RBI at the same price at which any institutions are buying. So this you can do. Okay.
Okay.
Uh, okay, son. So my camera is working fine now.
Yes, bhaiya.
Okay.
Perfect.
So I was talking about treasury bills. Treasury bills are basically the money, short-term money that government needs to raise. So it issues T bills for a shorter period of time. Now
Okay.
we go to certificate of deposit. Certificate of deposit is time deposit the bank. CDs are generally issued by commercial banks, but they can be bought through brokerages. They bear a specific maturity date from 3 months to 5 years. A specific interest rate and can be issued by any denomination, much like bonds. So certificate deposit is your nothing but fixed deposit, which we call in India FDs.
Yes,
It's
yes.
also another name is certificate of deposit. Certificate of deposit is again in India available from 14 days till generally more than 5 years, etc. Depending on the bank, and they do publish their
Interest
interest rate
rates.
applicable for different. So return for CDs are slightly higher than T bills, mainly because there is a default risk of bank.
Yes.
Let me tell you this, that the default rate of bank is obviously very low, and also deposits up to 5 lakhs. Deposits up to 5 lakhs in any registered bank, any bank is guaranteed by RBI up to 5 lakhs. So let's say if you are having any deposit in any bank up to 5 lakhs and that bank makes a default, that bank goes bankrupt, you will be paid. You have actually a guarantee or insurance from RBI, and
5
RBI will pay for your loss up to 5 lakhs only. So commercial paper is issued by corporation, like again, like Tata Steel wants to raise money, so it will issue a commercial paper. It will issue a commercial paper with a particular interest rate, and it will have expiry date as per its own requirement.
Okay.
As per its own requirement, they can borrow from banks, but they can also issue commercial paper. So if maturities of commercial paper are usually no longer than 9 months, with maturity of between 1 and 2 months being the average. So a company for their short-term needs, like say a company needs to pay corporate tax. It's a large company and corporate tax installment is, let's say, 500 crores. But that company is a growing company, and that company might not have liquidity for the time being. A company might not have liquidity for the time being, but company knows that okay, in 2-3 months they might be having that money, so they can float a commercial paper and raise that money for a short period of time.
Okay.
Over last 40 years, there have been only a handful cases of where corporation have defaulted on their commercial paper. Okay, so I am not personally not much aware about these markets as such, but again, I have more of an academic understanding of all these things, and we will leave this bankers acceptance, euro dollar we will leave. Okay, so you must have heard about RBI policies where they announce interest rate
Repo
for
rate.
repo and reverse repo, right? So we'll
Yes.
understand what is this repo and reverse repo. Repo is a short-term repurchase agreement. So let's say a bank, XYZ bank, needs to raise capital, needs to raise not capital, maybe they probably need it for their short-term borrowings, because obviously bank is dealing with deposits and lending. So
Yeah.
it is not likely that for every bank they will be matching. Some banks might be having higher amount of deposit, some banks might be having higher amount of lending requirement. So to balance that, RBI plays an important role, and one can buy RBI Treasury bills. So when RBI issues those securities, then they come with a repurchase agreement that okay, I am issuing a T-bill of 100 coupon, 1000. Sorry, not 100. Let's say with a face value of 1000. Face
Okay.
value of 1000. It has a expiry date of, let's say, 30 days. It has expiry date of, let's say, 30 days. Then it will not be it will be like something like that, it will be available in the market at a discount. So let's say interest rate is 6% per annum. So 1 month expiry is around 0.5%. So that instrument might be trading at 995.
Okay.
0.5%, it will be trading at a 0.5% discount. That on maturity value of that T-bill will be around 1000. So this is the rough idea that I have. So when RBI announcing those interest rates, basically RBI is announcing the rate for it is basically a short-term borrowing rate for banks. So RBI is saying that okay, I will give you short-term lending at this rate. So when we say repo rate is going up, that means that the interest rate for the banks are going up. Now, if any bank goes to RBI, and wants to borrow, let's say a bank wants to borrow 1000 crores for 2 months period from RBI, then when we say repo rate has gone up, it means that earlier, let's say bank was paying 5% per annum and it is raised to 5.5%. That means for banks, a 0.5% increase is a huge cost.
Yeah.
So this is, and reverse repo is that if
RBI
you are
wants
buying
money.
from RBI, then you have to pay this much, and if you are going to give it to RBI, then that will be received by you. So that is reverse repo rate. So reverse repo, I believe, is slightly lower than the repo. I am not too sure exactly. So I'll share the link to this paper, this PDF,
PDF.
and you can read about all the details
Okay,
of
yeah.
money market instruments and all. So basically, money market is a short term. To conclude, it is a short term borrowing market. In India, to participate in money market, we use liquid Bs. I
Okay,
personally use liquid Bs. So in liquid Bs, we buy them from the option brokers platform, just like we buy any share. Just like we buy any shares, we buy liquid Bs, and the amount of return that we get on liquid Bs is very similar to these money market instruments like T-bill, etc. Slightly lower than them, but uh, liquid Bs are a form of ETFs which are investing in money market instruments. Then I'll
okay,
explain you what is exactly ETFs here
okay.
and how we do it. So our
Bhaiya,
next topic will
liquid
be
Bs is government fund or it's any private sector fund? Liquid Bs are managed by government.
no. These are not managed by government, but the instrument that they are investing in are all government-backed securities like
Okay,
T-bills, etc. But they are necessarily investing in short-term money market instrument, which are very high liquidity and very high amount of volumes that are going in. But the rate of return is very high. We already discussed the first thing, T-bills, that we discussed at the top.
yeah.
The very high liquid and very low risk. So
Hmm.
risk return trade-off is very risk. The risk return trade-off is that it is very low risk and very low return. So I invest through liquid V's in money market because I many times have unused funds that are kept for my trading purposes. So at least I am making something on them instead of them lying in a current account. Okay, so brother, we will end it here, and
Okay,
then we'll take it further to ETFs and mutual fund in our next class. Okay.
okay.